We'll call to order the meeting of the Longview Firemen's Relief and Retirement Fund. Pam, if you'll take note of members present. Do we have any citizen comments? No comments. We'll move forward with the presentation of the second quarter performance from Will Harrell and Charles Smith of Robert Harrell, Inc.
All right. Good morning, everyone. Thank you, Mr. Chairman. We'll start, as always, with an economic commentary. Let me get this. All right. Mr. Chairman, I'm afraid that's about as good as I can do. Can you all see that okay?
Yes, sir.
All right, great. So jump right into Q2 market commentary. After finishing 2022 down 18.5%, the S&P 500 gained 16.7% for the first half of 23. The index gained 8.74% in the second quarter after gaining 7.5% in the first. However, we have had a bit of a pullback since the end of the second quarter. The S&P has technically been in a new bull market since October 11th of 22, having soared 27%. And as many of you know, a bull market is defined as 20% a recent low, 20% above a recent low, just like a bear market is 20% below a recent top or a recent high. As of June 30, the total return of the S&P was 19.6% for the trailing one-year period. That would be June 30 of 22 through June 30 of 23, 14.6 per year for the last 3 years, and 12.3 per year for the last 5 years, which really gives you a sense of how strong the market's been the first half of the year to have overcome a negative 18.55% in those trailing numbers. The bond index, the bond market, however, had the worst year on record, down 13% last year after the Fed raised interest rates 450 basis points or 4.5%. It was, however, positive for the first half of 23, rising just 2%. However, has given up much of those gains, if not all of those gains, recently, simply because we've had pretty robust economic data, which is indicative of the Fed continuing to raise rates, in which case the bond market will wait for a little higher rates to continue for that rally to begin. So the bonds will begin to rally, but it's going to be a few quarters from now if the economic data continues to be as strong and the labor market is as strong as it has been. Index was up 4.4 since hitting a low on October 21st of 22. The inflation data showed 1.1% growth in consumer prices, which brought the trailing annual inflation number down to 3%, though it has since bumped back up to 3.2%. And we, just like the rest of the investing public, are monitoring it very carefully. It is obviously a precursor to higher rates. The yield on the 10-year Treasury note ended the second quarter at 3.83%. It is now closer to 4.3%. And that's simply, investors believe the rate hike cycle is nearing its end. We'll go ahead and buy those treasuries while the coupon is relatively high, though there's probably a much larger camp that believes we are not done with the rate hike cycle. Therefore, those bonds are not in demand, driving yields higher as the price drops. Through the end of June, the 10-year versus 3-month U.S. Treasury yield curve has been inverted. That simply means that the 10-year yield is lower than the 3-month yield. These are government bonds, so there's no credit component in these bonds. But typically, or normally, the longer the bond, the higher the yield because of the time value of having tied up that money. So at the moment, we are 154 trading days back to November of 22nd, where that yield curve is inverted. And typically, it portends a recession. Since 1962, the longest streak with an inverted 10-year to 3-month yield curve was 209 trading days, ending in May of 2008. And I don't have to remind you what happened in October and November of 2008. And in order to break that record, the curve would only need to stay inverted through mid-September of this year. So this is something else that's being very closely monitored. Over the last 12 months, average monthly annualized sales of existing homes have been 4.5 million, the lowest level since August 2012. Supply is being driven by rising mortgage interest rates, remains the main culprit, as inventories of homes listed for sale fell to 1 million, which is the lowest level for the month of May since at least 1999. And a big component of that is that current homeowners that have relatively low mortgages, say anywhere from 2.6 to even 4.5 or 5% on their mortgage interest, are not willing to sell their home to then jump into a 7.5% or approaching 8% mortgage. Therefore, the housing market, particularly for existing homes, has really, really dried up. I read the other day that for individuals earning around $100,000, the number of affordable homes during the pandemic was about 650,000, and right now it's about 240,000. So there is absolutely a dearth of supply when it comes to existing homes. Then real GDP grew by 2% in the first quarter of 23, driven by strong consumer spending, up 4.3%, which is the strongest in 2 years. And you might have heard that Americans are now they've not only exhausted their short-term savings, but they're now beginning to put money, or rather purchases, on credit cards. And the big news lately has been that credit card debt eclipsed $1 trillion for the first time in history. And a lot of people that's causing a lot of anxiety regarding the consumer. But if you look at it on a long-term basis, right now, the U.S. consumer has roughly $19 trillion in discretionary income, in disposable income, 19 trillion. So as a percentage of that disposable income, the 1 trillion is roughly 6%. If you look back historically, that number is closer to 9% on a long-term basis, which simply means that yes, the $1 trillion number is scary because it's $1 trillion, but at the same time, the consumer has a commensurate amount of additional disposable income to cover that debt. Current U.S. unemployment rate remained at 3.6% through the end of June 23, though there are still about 6 million unemployed members of the workforce. So our clients fully invested, diversified, and rebalanced diligently, and this portfolio was indeed rebalanced just before the end of June, meaning that every single investment that we can, meaning all of the liquid investments, were either sold or bought to get back to their target weight. Therefore, the risk management effect of that means that the portfolio, for example, if the portfolio had not been rebalanced towards the end of June, and we would have had the same sell-off that we've had in July and particularly in August, the portfolio would have suffered more because the equities and the stocks would have been overweighted and thus punished proportionately. And so rebalancing prepares that portfolio for whatever comes its way. S&P was up 8.74% for the second quarter, up 19.6% for the trailing year. The bond index was flat basically for the second quarter and basically flat for the trailing year. In fact, the bond underperformance for 2022, that negative 13, the magnitude of that underperformance is so great that it has wiped out the bond index performance for the trailing 5-year period. Because typically, historically, the bond index is not designed to produce more than, say, 4 to 6% in return, and a negative 13 really does a number on the trailing the trailing numbers. International stocks up 3% for the quarter, up 19% for the trailing year. Emerging markets were up 1% for the quarter and up 2% for the trailing year. Pardon me. And when you think of the emerging markets, it's, Brazil, Russia, India, China. And as you might have read in the papers or rather online, China is having all sorts of economic problems. They seem to be in this sort of Japan-like boom and bust cycle of the 80s, and their economy is absolutely slowing. They're in an absolute real estate near crisis, and the unemployment rate for their youth, meaning, say 20 years old, the unemployment rate is over 20%. So from an economic standpoint, China is absolutely teetering. Therefore, I imagine the talk of ever changing the reserve currency from the dollar to the yuan is pretty over exaggerated. The TIPS index was down 1.42% for the quarter, down 1.4 for the trailing year. Oil closed the quarter at $70.64 per barrel, but that's, oil is now at about 82 bucks a barrel thereabouts. I haven't looked today. So it's up now from the end of 22 by say 4%. Mr. Chairman, are there any questions on the economic commentary?
Not specifically about the economic commentary, but we are approaching the 1-year anniversary of the investment of the bond, pension obligation bond. I realize we did it in 3 tranches, July, August, and September. Do we have a rough idea of what type of return we achieved in this 12-month period, or do we need to wait till the end of September?
No, we have it. We have it. We have it right here. Terry and Scott have done a wonderful job, your crew there at the City Hall, training me on how to be a much more effective presenter vis-a-vis technology. So I've got a lot of new tricks up my sleeve, I think. There we go. All right, so this would be the June 30, and I'll get to that return in just a sec, Colby. The June 30, bump this up a little bit. This would be the June 30 balance sheet. The pension fund was right at $90,966,877.05. We had just over $1.7 million in cash. 61% was in equity funds. Our 2.35% in Millennium. The alts were 2.19%, and then the bonds were 32.6%. The total asset allocation target is 65-35. And as you know, each one of these investments, each one of these rows has its own weight as well. This is a graphic representation of the prior page. I would just comment, it is a highly diversified portfolio from large cap index, from the large caps here, the mid caps here, the small caps down here, REITs, a little private real estate with the Kyle Project at Rastegar, Vanguard International, Vanguard International Growth and Value, T Rowe Emerging Markets. We'll be asking to replace T Rowe today. I've got some data on that. The hedge funds, the alts, all the way around to the fixed income instruments back down to the cash. This is your asset allocation by asset class. So 43% domestic equity, 9% international, 5% real estate, 5% emerging markets, 32% fixed income or bonds, 4% alternatives, and 2% cash. This is your unit value schedule going back to 2011. So you can see back here, this would be the quarter ending date. The market, let me see if I can blow this up just one more. There we go. The quarter, well, I'm gonna have to, anyway, quarter ending market value, contributions or withdrawals. So quarter ending date, quarter ending market value, net contributions or withdrawals, the nominal return, the unit value growth of that nominal return, the the CPI, because you've got an inflation assumption embedded in your actuarial target return, and then the real return, which is what we refer to as really the actuarial return of the portfolio. And trekking along, just to hit a couple of signposts. Here's 2018 recession fears. We had a negative 3.1 after a pretty decent year. You can see the 2%, 1973. These are your inflation numbers over those years. So negative 3, 2, you get a negative 5. 19, 18.93, 2.2% inflation, knocks you down to a 16.5. 2020, this is your pandemic quarter, down 13.9% and wound up with a positive 11.5 for the year. 1.2% inflation, very low inflation, leaving you with a net of 10.14. And then 21, you begin to see, let me blow this up just a smidge. 21, you see 11.18% return, but we had 6.9% of inflation. So our actuarial return was just 4%, just shy of 4%. And all of these returns are net of all of the investment related fees that the fund pays. And then 2022, you can see negative 5, negative 10, the infusion of 44,576,185. That is not the total number for the bond raise. That is the total number for the bond raise minus outflows for that quarter. And as you mentioned, Mr. Chairman, this was done in 3 tranches in 22. The first tranche was about flat. The next tranche we caught an excellent dip, and we caught another good dip in the third tranche. Those were monthly tranches. However, you can see that negative 14.76. I mean, fortunately, the tranches began after that second quarter. A lot of the damage was done here. So the tranches were done, you began just at the bottom, really at the bottom of the market. It was very, very fortuitous that we were able to invest that money in what was a very bear market at the time. So that negative 14.76 with a positive fourth quarter, we had 6.47% inflation, which exacerbated that negative return. And here we are with a negative 20.54. This to us is a 2 sigma in our analysis, which comes out in February of each year. This would be a 2 sigma event, meaning this is 2 standard deviations from the mean or the average, meaning it's just not likely to happen. But every 25 years or so, it does. So over that 12.5 year annualized 12.5 years, y'all have gone from, $43 million to nearly $91 million. You've added $22.2 million to that, and the rest is growth. Your target rate of return is 7%. This 4.28, this 22 really wiped it out, but this number needs to get closer to 7. This is the actual inflation that you as a pension fund have experienced. Your assumption is 3%. So you're almost right on top of your inflation assumption. And then, and then the 1.56 would be the net growth of the pension fund over that entire 12.5 year period. And I can tell you that over the last 5 years, the pension fund has had miraculous growth compared to those first 7. Let me blow this up just a bit. All right. At the very top of this would be our executive summary. So this digs into how well the pension fund is doing from above, which is up top here. Longview Firefighters total plan, nearly $91 million in a balanced peer group. And so if you take your 5-year return, your trailing return of just under 5%, 5% doesn't sound wonderful, but when you drop it in your peer group, you're outperforming 56% of your peers. And over a 3-year period, which includes COVID, and includes 2022, your 3-year return is 7.35. Pardon me, I need to close this door. Excuse me. Sorry about that. So you're trailing a 7.35% on the 3-year return, which outperforms nearly 90% of your peers, which is, obviously a great improvement. And your 1-year return is 8.71% in the 33rd percentile ranking. So, Mr. Chairman, as that money was coming in, you were just about flat for Charles can get you an exact, but because of those tranches, as you mentioned, it does get a little muddy. And so your general return from the point at which the POB money was invested was 8.71%. Are there any questions, Mr. Chairman?
No, I appreciate you clarifying that for us.
Not a bit. If you'll give me 10 seconds, I'll be 2 seconds. I'm sorry about that, Mr. Chairman. My son's having his wisdom teeth out this morning, and I am working from home. All right. On to the individual managers. Loomis Sales Large Cap Growth Fund, as you can see, in the top 16th, so outperforming 84% of 612 peers over a 3-year time period. And as the board knows, we do spend most of our time on the 3-year period because the 1 year does tend to jump around quite a bit. And so our 3-year is our best barometer for making changes, we have found. So Loomis Sales 16th, Vanguard Equity Income 32nd, Clearbridge 38th. They replaced William Blair's Mid-Cap Growth, if you recall. Diamond Hill 59th. JP Morgan Small Cap Growth is not only on the watch list, but Charles and I are about 85% completed with a replacement. We're monitoring them on a monthly basis, and we have our finals meeting with their potential replacement tomorrow morning. And therefore, the next time we meet, and depending, Mr. Chairman, if their performance does not really change here at the end of August, given we'll get some August data. If their trajectory is not very positive, we might request that we join your September meeting, perhaps, to simply do a quick manager review for a replacement.
Just keep us informed if you need to do that.
Yes, sir. Thank you.
I have a question real quick.
Sure.
So on these funds, you're doing it based on peer group. What about benchmark, like the index?
Yes, sir. Well, the benchmark is we start with benchmarking, but it's very difficult to make a decision based on benchmarking because it's always a matter of how far underneath the benchmark are they and for what period of time. And so creating a decision rule is tough. Plus, this peer grouping, this alpha rank, has got the benchmarking embedded in it. So one of the issues with benchmarking is that there's an inherent difference between the manager of interest and the benchmark or their market or their proxy. So what this enables us to do is make an adjustment, a risk adjustment, using their proxy without being so tied to the benchmark. And as a group of fiduciaries, we feel that it's important for the trustees to know. I mean, the benchmarks are back here in the report. They're deeper in the report, and I'm happy to cover them. But as far as this executive summary, the reason why we use this methodology that's got the benchmarking already embedded in it, if the market has got a high enough R squared, we use that benchmark to make the risk adjustment. And then what we're doing is we're quantifying the individual managers, the active managers' ability to select stocks or bonds, his or her ability to select stocks or bonds. And then, of course, as a group, as a board, we always want the fiduciaries to know what the opportunity cost is of holding on to an underperforming manager and how many alternatives do they have in a given peer group and how that manager is doing on a relative basis. So the benchmark, we do use benchmarking, but it's almost embedded in this methodology, and it can be found explicitly later in the report.
All right, thank you.
Yes, sir. That's a great question, by the way. It's Vanguard Equity Income, 32nd, Clearbridge, 38, Diamond Hill, 59th. I mentioned the JP Morgan. MFS slipped a bit, but they've got a really good record of coming right back. You see their long-term record, 13th. Vanguard International Growth slipped a bit, but again, they've got an excellent long-term record and a history of rebounding. Same thing with Vanguard International Value, though they haven't really slipped that much. T. Rowe Price Emerging Markets Fund. This is a fund that we've discussed many times over the last couple of 2 or 3 meetings. We have a replacement for them, and I'll get into that in just a minute. Therefore, and for the gentleman who asked the question, the reason, the cutoff point is really that 3 year. When a manager hits that 80th percentile on a risk-adjusted basis on a trailing 3 year, particularly when it bleeds into their 5 year, like this has, there are several things that have happened. The manager is now underwater. They know they're underwater. The likelihood of their digging themselves out of the statistical hole is getting very, very small. The opportunity, of course, they know they're underwater, and they might do something to get themselves out of that hole that we never signed up for. And then third, look at this peer group, 697 managers on a 3 year basis for the T Rowe. So they're 91st on a risk adjusted basis. So 90% of 697 managers are currently outperforming them. And the opportunity cost, as I mentioned earlier, of the trustees having held onto a manager like this is just getting too large to defend. So we don't like to make manager changes, every quarter. And if we ran by the 1 year numbers, we'd never stop hiring and firing people. But with this methodology, we do wind up having maybe 2 managers per year as far as turnover, which is a good thing because you're pulling the weeds that need to be pulled. And under no circumstances will we ride a manager into a mountainside simply because we, quote, like him, if that makes sense.
It does. So when do y'all decide to incorporate indexes in here? Like I see the iShares Russell Midcap and iShares Core REIT and the Vanguard Russell 2000. When do y'all decide if that's going to be the appropriate route to go compared to a fund manager?
That's a great question too. When we do our let me start over. When we do our manager searches, we are completely agnostic as to whether it's an active or an index fund. If passive index funds outperformed most all managers across the board, this whole plan would be full of them. But there are many instances where they just don't outperform their active counterparts if and only if you have a methodology for measuring and quantifying the active share of the manager. So our methodology enables us to employ active managers where it's appropriate, and then also be completely open to whom, like this large core is an index fund, our mid core is an index fund, our small core is an index fund. We've also got a mid cap growth ETF. This is simply a function of these. Every time there's a manager search, we don't have like a stable of managers or a list that we get, you know what I mean? We don't maintain a list of preferred managers or anything like that. Every new manager search is a fresh manager search, as though we've never done it before. And the reason for that is you never know what manager has just broken through some threshold, like AUM has just gotten them on the radar, or they've just hit their 5 year numbers. So we do fresh searches, and what is used here is simply a function of when we did the search, was there a compelling active manager that net of their fee produced reliable alpha? So it's a mixed bag.
Appreciate it. Thank you.
Sure. No, I love the questions. Just ask these folks. I can talk about this stuff for days. No, I can't see y'all. Y'all shouldn't be laughing. All right, BlackRock High Yield Bond Fund. 32nd, so that's top third across the board, top quartile on the 5-year. MetWest floating rate fund. I've mentioned this several times in the recent past. This floating rate bond fund's utility to the portfolio had everything to do with rising interest rates. We are still in a rising interest rate environment, and the insulation that floating rate bond provided the portfolio can be seen easily in the 2022 performance of not only the bond index, which was down 13%, as I mentioned before, the floating rate was down only about 7%. So it acted as a great cushion for some of the damage done by rising interest rates. But there's going to come a point at which the interest rates will begin to flatten. There'll be talk of a pivot. And then when they begin to fall in earnest, and this could be some time from now, that floating rate bond fund, we're going to have to collectively decide where that money goes, because the utility of having it in that floating rate bond fund will have run its course. And then now we get, and also, sir, the gentleman who asked the question about the benchmarks, you'll notice that the prior page was peer size, return, and so let me blow this up a little bit. Oh, Lord, hold on. Peer size, alpha, and rank. All of these investments are return and rank. And what that means is these are either index funds that are not designed to produce alpha. Their alpha would be 0 if it were calculated, or they are typically bond funds or alts that have such a low R squared to a given benchmark. Like you were asking about benchmark. It's a great question. Like Guggenheim Total Return, it's an excellent bond fund, but it's really nothing like the Barclays Ag. The Barclays Ag is 44% treasuries. And so, we probably wouldn't pay a manager to go buy a bunch of treasuries. We could do that ourselves. So Guggenheim Total Return, same thing with PGIM Total Return. They're so unlike that benchmark that using the benchmark for a risk adjustment does not make any sense. The R squared is too low, therefore, which is a fit statistic. So we revert back to just simple return and rank. So Guggenheim Total Return. So anyway, I'm sorry. Vanguard, and you would expect the index funds to be, top third, top quartile, and they are typically. Vanguard Large Cap Core 34th, Vanguard Mid Cap Growth ETF 30th, 35th, and 51st. iShares Russell Mid Cap Core 29th, 77th. Interesting, during the during 2022, a lot of these index funds, when the market was down 18.5%, and you've got an index fund that's taking full market beta, and there is no manager at the helm to make any trading or to do any risk management whatsoever, or any, deck chair arranging on the Titanic, it goes to the bottom of the peer group. And you can see that on the 77th on the 3-year and the 86th. It's very, very rare for a small cap core index to be that low. Historically, they're closer into the 30s. You can see the mid core has begun to normalize up in the 26th. And the small core has begun to, but I've said in the last, 3 or 4 meetings, that if that persists, if that 86th really persisted, we would go out and do a search for a small cap core active manager, because at that point, it would be clear to us that we could get more return out of an actively managed fund, as that small core, which is the benchmark, is lagging at the very bottom of the peer group. And that is so often the case when you get into the passive versus active argument. Most of the data that you read about passive versus active, if you read the footnotes, if you read the fine print, they're almost always talking about large cap. When you get down into mid cap and small cap, it's not the same. There's far more inefficiencies down the cap scale, and you can get a lot more alpha out of those. And but of course, the argument that large caps are so efficient that we know everything about them, which is ridiculous, because if that were the case, WorldCom would have never gone down. And some, Bear Stearns, Lehman Brothers, those were giant companies that apparently everybody knew everything about, but no one knew anything about what was really going on. So there are inefficiencies to be had up and down the cap scale. You just need to know how to measure for them and monitor them. That's all. And then the real estate, the REIT, that's obviously an index fund, top decile. Guggenheim Total Return, top quartile. PGIM, these two funds are complementary of one another, and we don't really typically expect them to perform the same way over the short run. They'll balance out over the long term. They're both very good, but they're very complementary to each other vis-a-vis their sector allocation. Much better than buying the Barclays Ag as an index fund. JP Morgan Global Opportunities Fund, 1st, 2nd, and 14th. Millennium, 1st, and 5th. So your hedge fund, and if you're wondering what that hedge fund was investing in when it was just crushing it, they were mostly in commodities in 22. So when the world was ending and the price of oil was skyrocketing and the price of everything at the grocery store was going up, that's where Millennium was. That's the utility of owning Millennium, is that they take a complete opposite view or an opposite stance on what is in favor or fashionable. And it typically is a great offset in rough years for domestic equities. And then Blackstone's Breads Real Estate Debt Fund, 7.7%. Cohesive Capital, private equity up 41% for the 3-year and up 94% for the 1 year. PIMCO Bravo Fund down 12.18. That's more of a distressed bank assets fund that we are slowly liquidating. And then Student Housing up 9.21% for the 3-year and down 2.26 for the 1 year. Let me get back. All righty. This would be the Longview total. Let me blow this up a bit. No, I think I can get away with that. All right. So you go back 10 years and this total fund benchmark is a very granular benchmark, meaning that if you recall that asset pie earlier of the individual investments, that each one of those investments has an associated benchmark and a target weight that we rebalance to twice a year. That is what the Longview total fund benchmark is. So it's not like 65% S&P 500 and 35% Barclays Ag. It's very, very granular to give us a best sense of how the portfolio is doing against its custom benchmark.
Will, could you lower that a little bit on the screen? Thank you.
Is that good?
A little bit more.
Oh, wait, hold on.
There we go.
How about that?
There. Okay.
How about that?
Okay.
Is that Maria?
Yes.
All right. Is that good?
Yes.
I can't see a thing but my own screen. Apologize. All right. Going back 10 years, 4.76 versus a 5.43, 4.96 over a 4.8. I believe we were hired right at 5 years ago, or about 5.5 years ago. 4.96 versus a, so actually there was a big, quite a facelift between the 5 and 10 year number. When we were hired, we did employ some more diversification strategies, spread out the domestic equity, and begin to chip away at the alts. And then you see the 4 year, and of course, keep in mind that the benchmark does not have any fees associated with it. So that total fund benchmark is a gross number, and the total fund number is a net number. And there is, I'm not exactly, but about, call it 80 basis points worth of fees inside the pension fund that are not being, netted out of that benchmark. So you get to the 4 year period and 5.03 versus a 4.68, there's some very good outperformance. 7.3 versus a 5 on the 3 year, that's the COVID time cut. That's very, very good. -3 versus -3.42. Again, outperformance, 8.71 versus 8.95, pretty much in line, but if you were to net out the fee, that's outperforming as well. And then 8.08 over a 7.4, that's year to date. So really, ever since we put this new portfolio in place, y'all have outperformed your benchmark, well, just about every year, which is how it ought to be. I mean, goodness. All righty. And so this would be the last page of your report. Is that good enough? Can you see that, Maria?
Yes.
All right. I'll be checking with you for the remainder of the meeting. So now you see that 10-year, that 70th return. So for the gentleman who asked that question before about the benchmarking, so you can take not only the benchmark, the custom benchmark, but you can take the total portfolio and drop it into a peer group to again give you a sense of not just how is it doing in absolute terms, but how is it doing in a relative sense to other portfolios that are similarly constructed or have a 65-35 mandate. So 70th percentile on the 10-year, the 5-year jumps abruptly to 43rd, 4th 38, 10th, our third 3 years 11th, so not to your top decile. 2 years we've had, but you're right in line with the benchmark. So you can see that 2-year period, yes, the portfolio suffered over that 2022, but so did the benchmark as well. The 1 year, so that's June 30 of 22 through June 30 of 23, right in line with the benchmark, and then year to date outperforming the benchmark, just barely, but nevertheless. So I guess the real takeaway from the report is that the portfolio is doing very, very well from a performance analytics standpoint, and we wouldn't make any changes to the asset allocation. Of course, we make those recommendations in February after we're able to test the portfolio over the prior time period and see if the constituents have changed their risk characteristics very much. But at the moment, the portfolio seems to be doing very, very well. And about an 8.5% return, Mr. Chairman, is what you would probably assume from the POB money.
Very good.
Yes, sir. Now let me jump to, where did my thing go? Now let me go to this. Oh, nope, that's not right. I hit the wrong number. Hit the wrong F. All right. So we would like to replace we'd like permission to replace T. Rowe Price Emerging Markets Institutional Fund, which has been with the plan now probably 5 years or better, with the Fidelity Advisor Emerging Markets Discovery Fund. As I mentioned earlier, all of these searches are completely blind. We start off with a clean slate. We're recommending the iShare, the institutional class, FEDIX, so obviously no front-end load, no back-end load, and the lowest expense ratio we can get. Expense ratio is 1.17, which is right in line with the T. Rowe. That's class I right there. For what it's worth, Morningstar thinks they're neat. And okay, let me blow this up a little bit, and I'll get to our report in just a sec. I just wanted y'all to see some more of this. All righty. So you can see the regional diversification. Emerging Asia, they're a little lighter than the benchmarks up top right. I'm sorry, my cursor doesn't always work in this setting. Emerging Asia 62.2. So a little light on the emerging Asia. Latin America 25 over 10, Middle East 5%, emerging Europe 3, Africa. So Asia and Pan-Asias, think South Korea, think Vietnam, not just China, is really where, in Taiwan obviously is where you're finding a lot of the investments. 98.7% on the bottom left is emerging markets, so it's not going to step on the toes of our Vanguard developed. It does on the bottom right. You'll see the style map. It is not a full-on large cap emerging markets fund. It does have a little bit of mid cap in it, which is something we really, really like from a statistical standpoint. You can see that the China is 19%, India 15.14, and that ratio right there, if China continues on the path it's on, I would not be surprised if in a year's time it was 19% India and 15% China. Taiwan 15%, Brazil, Mexico, Korea, South Africa, Saudi Arabia, UAE, and then a little bit of Hong Kong. I think our reports are a little more, and the manager's been there since, he is an Asian fellow, been there since 10 years. We have had meetings with these folks and done all that type of due diligence. So we're very, very comfortable recommending them. And this, I think, would give you a little more insight than their sales slick. So this looks over from July. This goes back 5 years on this particular fund. You can see the return, 3.01, 1.59 for the benchmark, 18.9 on the standard deviation. So it's got a higher return, lower risk than the benchmark. The downside risk is lower than the benchmark. You can see that it's controlling the market beta a little bit. So it's not fully exposed, which is a good thing. That's risk management. Alpha versus market, that's a great absolute number for emerging markets. That R squared, that's that R squared I kept mentioning before. If that number is not above 75 or 80, it means that we're going to have a much more difficult time making a risk adjustment using that market, this 100 down here, because they're not apples and apples. And so it's critical that this R squared is high enough to actually give you a good alpha number. Sharp ratio is pretty good, and then the tracking error is pretty low given emerging markets. The tracking error is just the standard deviation of the excess return. So if it's providing excess return, how reliable is it? And so the lower that number, the better. This would be the return for, let me blow this up a bit. I'm getting so good at that. How's that, Maria?
A little bit lower.
Lovely. All right. The benchmark, obviously, on the bottom row, and you can just see very positive, reliable outperformance by the manager. And then this would be your return rank. So clearly, I mean, those green dots are all the way across the top. So it is outperforming its benchmark, but it is at the very top of that given peer group. And then this would be the alpha. So that's the absolute alpha, like just the number, no ranking. And you can see just for education purposes, that bottom, here, let me blow this up, blow it down. See how that benchmark does not produce alpha? It's 0 across the board. That's what's being used to calculate the alpha. Because look at it this way, and I wish I knew that gentleman's name. I'll get it in a minute. I don't want to interrupt anything right now. But, sir?
That's John.
John, thank you so much. I appreciate it. I hate to keep referring you to the gentleman. But but so that benchmark is not producing alpha, and the manager is. And if the manager's risk is close enough to the market, to the benchmark, we can use that market to calculate how good is his stock selection skill. Because, for example, if I have two large cap growth managers and they both got me 10% at the end of the year, but one did it at a standard deviation of 5, meaning that he was between, say, 5 and 15 throughout the year, and I got a 10. And then the other manager got me a 10, but his standard deviation was 20. So throughout the year, he was negative 10 and positive 30, only to arrive at a 10. I'm going to want the manager with the highest return per unit of risk, which is what this alpha calculation is trying to tease out of the stats. And then this would be the alpha rank. So once you've calculated that alpha number, which can be considered the value add, or there's a million ways to describe it. But once you've calculated that absolute number, then do that exercise for every manager in the peer group, drop the manager of interest alpha numbers in that peer group to see how they do. And so if we weren't able to find a manager that we felt really, really comfortable with, given the performance of this benchmark, we would sleep fine buying the benchmark. But given the portfolio's life expectancy, we know that squeezing out every little bit, compounding annually, makes a big difference in the long run. So we still feel like there's enough value add here to keep a hold to hire this manager. Mr. Chairman, I swore to myself I wouldn't go that long, but
It happens.
it happens. Yes, sir. And that would conclude our report. Our one request is simply to have the authority to replace T. Rowe Price Emerging Markets with Fidelity Emerging Markets Fund, and that would, if approved, take place this afternoon.
All right. If you'll hold 1 second, I can give you that answer. Let's move to action item A real quick, review and motion regarding the second quarter performance from RHI.
I motion to approve.
A second.
Any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Item B, review and motion regarding the recommended trade of selling T. Rowe Price and replacing them with Fidelity based off RHI's information.
Motion to approve.
Second.
Got a motion and a second. Any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Did you hear that, Will?
Yes, sir, I did. Thank you, Mr. Chairman. And with that, we are more than flexible. We know y'all have some other presentations. We're happy to stay online if you'd like, or we can. We're here at your pleasure.
All right. I don't know that we'll have any other information, but you're more than welcome to stay for the presentation, and if something comes up, we could certainly refer back to you.
All right, thank you. And
Thank you.
thank you very much for the questions, John. It's very nice to meet you.
Nice to meet you too as well.
I look forward to continuing this in November.
Yes.
All right. Next, we're going to move on to presentation B, the 2022 Actuarial Valuation from Foster and Foster.
Okay, so is this on?
Yes.
Okay,
Yes.
perfect. Sorry. Okay, so while Pam is getting this set up, I just want to give a brief introduction to myself. So my name is Lindsay Redmond. I am a pension actuary with Foster and Foster. I've been with Foster and Foster for right over 5.5 years now, and ever since I joined in November 2017, I've been a member of the client team working on the Longview Firemen's Fund. I am a member of the society, or an associate of the Society of Actuaries, and I just recently became an enrolled actuary in March of 2022. So prior to discussing the results, I want to just give a brief overview of everything that occurred during 2022. Obviously, as all of you know, a $45.6 million pension obligation bond was approved, and the proceeds were deposited into the fund in July of 2022. The city also reduced their contribution rate as part of the pension obligation bond agreement from the original 19% of payroll down to 12% of payroll. So whenever we did our supplemental analysis on the impact of the pension obligation bond using the prior year valuation results, we estimated that the amortization period would reduce from infinite, meaning, the unfunded liabilities would never be fully paid off, to a 27.5-year amortization period. And then also, with the $45.6 million coming in, we estimated that the unfunded liability would reduce from $73.3 million down to $29.4 million. Overall, plan experience was unfavorable based on the plan's actuarial assumptions. The two primary sources, one, of course, being the investment rate of return on an actuarial asset basis, which is the 3-year smoothed asset value. We estimated that the investment return was 3.43%, which did fall short of the 7.5% investment return assumption. And then the other primary source of, primary source of loss was due to average individual salary increases being higher than what is assumed using our salary increase rates that are used in the valuation. Okay, so looking at the total accrued liability, it did increase about 2.6 million from 123.3 to 125.9 million. Looking at the actuarial value of assets, for the prior year valuation, that was basically right at 50 million, and now we're looking at an actuarial value of assets at 91.2 million. Or 94.2 million, and so that did increase around 44.2 million in total. Looking at the resulting unfunded liability, which is just your liabilities minus your assets, we are now sitting at an unfunded liability amount of 31.7 million, which, looking at the prior year results, that is a decrease of 41.6 million. However, looking at, if you were to look at the supplemental analysis that we provided, where we estimated that the unfunded liability as of the previous valuation date would be around 29.4 million. We did see that somewhat increase. It would have been around a $2.3 million increase. So next, looking at the normal cost rate, you can see that the normal cost rate did decrease 43 basis points from 16.76 to 16.33%. This is a trend, that we should continue to see, just because as, Tier 1 members are replaced with Tier 2 members, whether it's due to termination or retirement, those Tier 2 benefits do cost less to the fund. And so, as I said, that normal cost rate you should see that start to decline still year over year. Looking at the funded ratio or funded percentage, we do see that increase over 34%. From 40.5% as of the previous valuation date to 74.8% as of December 2022. Finally, we do have an amortization period of 27.6 years. A couple things to note about this. Although one of the primary sources of loss was due to average individual salary increases being larger than expected, you do start with a larger payroll amount whenever we project out the paying off the unfunded liabilities. And so with that higher starting payroll amount, you do have more contributions coming into the fund in order to help pay off that unfunded liability. And then also the amortization period does reflect that the city's contribution rate will increase back up to the 19% of payroll once the pension obligation bond matures in July of 2047. Are there any questions so far?
I assume in the actuarial value of assets, our outperformance from the prior two evaluations and that 3 year of smoothing carried in to help that. That's why there's the difference in the actuarial versus
Yeah, we'll get to that in one of the other slides. I'll kind of get into a more detailed calculation of how the actuarial value of assets is determined.
All right.
So looking at the contribution rates, as I mentioned, the city did decrease their contribution rate to 12% of payroll, and it'll increase back up to 19% effective in July of 2047. And then the membership, depending whether you're Tier 1 versus Tier 2, Tier 2 members are contributing to 15% of their payroll, where Tier 1 members are contributing 17%. Next, looking at the actuarially determined contribution benchmark. So the benchmark calculation is determined in accordance with the funding policy, and we've been including this benchmark calculation in our reports ever since the December 2019 valuation. And so really the ADC is comprised of two components, one being the normal cost rate, which as of the valuation date was 16.33%, and then the other component is the amortization rate, which that is calculated using the amortization payment as shown in the schedule. Originally, whenever we first calculated the ADC, we calculated a 30-year amortization payment that would allow the unfunded liabilities to be completely paid off in 30 years. And so from then, each year, a new amortization base has been established based on, the increase or decrease in the UAAL compared to what was expected. And so based on the schedule below, the sum of the December 2022 amounts in the second right-hand column, you can see that the sum of those amounts does total the 31.7 million, which is equal to the unfunded liabilities as of the valuation date. And then the remaining, or the sum of the amortization payments, that each for each base, the December 2022 amount is amortized over the years remaining that is shown. And so the total of the amortization payments comes to 1.93 million, which in terms of the amount of payroll is about 12.93%. So including that with the 16.33% normal cost rate, we do have a total ADC of 29.26 of payroll. And so in total, the contributions coming into the fund are 12 from the city and either 15 to 17% of the payroll. And so whenever we determine what the benchmark is, we do subtract out what the membership is paying. And so as of the valuation date, given the makeup of Tier 1 versus Tier 2 members, we did estimate that the member contribution rate was about 16.31%. And so the remaining ADC benchmark, which is the city's portion, is the 12.95% of payroll. And so there is still a shortfall of 0.95%, so almost 1%. But I will say that, if you look at the December 31st, 2021 valuation, there was a 12.32% shortfall, and that was with the city, even, having a higher payroll contribution rate of 19% rather than 12%. So you can see how much of an impact that the pension obligation bond has made in getting the fund into a much better position. And one thing I do want to say is even though the amortization period is under 30 years, the reason why this is showing a shortfall is because whenever we project out the amortization period, we do account for lower normal cost rates in future years due to Tier 1 members, retiring or terminating, and incoming Tier 2 members have that lower cost rate or lower normal cost rate. And whereas it does assume just the flat, it's only taking into account that 16.33%. So that is why you're seeing somewhat still of a shortfall, but that the amortization period is still below that 30-year mark.
So I got a question on the ADC. As we move forward, will that percentage continue to go down as well as we Tier 1 guys start retiring? And so that that total cost for the year, will it continue down? Because we're 0.95% short this year, but this year we'll have more retire.
Right.
So will that be like 0.5% short next year?
It really depends. So so it's comprised of those two components. It's comprised of the normal cost rate, which that will continue to go down, or hypothetically it should, and then the amortization payment. And so if you go back to this slide, you can see if there was if the expected was actually more than what was the actual unfunded liability was as of the valuation date, you would see one of those bases be negative. And so what we've seen every year is that especially with, assuming a flat payment over 30 years, you do have negative amortization, which means, that payment will eventually, fully pay off that unfunded liability base. But in those first years, you actually do see as of 12/31/2020, you would have seen that initial, whatever the unfunded liability was at the beginning of that prior year, you would actually see that 12/31/2020 amount be higher just because the amortization payment doesn't fully cover the interest.
Right.
So, but in future years, obviously, as Will was saying, we're in really good shape so far for the 2023 calendar year in terms of asset return. And so it could be possible, that next year we do have an unfunded liability that is less than what was expected, and in that, we should see, as a percentage of payroll, that amortization rate be lower. So it really there's a lot of factors that come into it, but in terms of the normal cost rate, that should, continue to be going down.
I have one question about the ADC. We're in a period at the Department of Payroll growth right now, and with that increased payroll growth and more contributions coming in from payroll growth, is that gonna help offset that 0.95 that we're short on a cash value?
I mean, so I would say that, you know, in terms of, you know, paying off the unfunded liability, you know, this first year, we did start out with a higher payroll amount. And so, you know, technically more contributions are coming into the fund. And so from that standpoint, you know, it could be that next year, you know, the unfunded, like I said, is less than what was expected. And so, yes, you could see that amortization payment as a percentage of payroll go down. And then, of course, with a projected lower normal cost rate, you should continue to see, I mean, it still could be a shortfall next year, but you should, if everything, especially in liabilities, you know, if everything, if actual lines up with what is expected, you should see that the ADC benchmark as of next year fall.
I assume that that's a double-edged sword, though, that increases your liabilities if someone's in their final calculation years, which would, of course, negate the positive. Is that something that's tracked when there's overtime tends to be with worker shortages more predominant in ours and many fire departments? Does it track who theoretically could be in their calculation years versus if guys at the beginning of their career are getting the overtime, obviously that's not going to end up in their final calculation. Is there a way, is that weighted out somehow in that calculation?
No, so this is really just looking as of just this valuation date. It's not really looking at anything future. For purposes of the amortization period, however, that does project that normal cost rate. And so, you know, as, like I said, the Tier 2 members are coming into the fund, lower cost to the fund in terms of the percentage of payroll, the normal cost rate, that should be reflected. But in terms of this calculation, it's not really looking, you know, it's not really forward-looking. It's just looking, you know, at where the unfunded liability is now, and then based on, you know, the schedule as well from previous years.
Thank you, ma'am.
Okay, so looking at the market value of assets, so compared to last year, we did see an increase of about $33.1 million compared to the prior valuation. We do show that the estimated rate of return is about -11.5%. I will say that, you know, obviously the only reason the market value increased was due to the large the POB proceeds that was deposited into the fund. But I will say that, you know, even with how the stock market performed in 2022, our estimated rate of return, you know, is not as extreme as some of the other rates of return that we've seen for other calendar year plans. A lot of that probably has to do with, you know, where the pension obligation bond and the timing of that being deposited into the fund, because, you know, it did not see those losses from the first 2 quarters of 2022. And then finally, looking at the actuarial value of assets. So the way that this is determined is for Longview Fire, the actuarial value of assets is a 3-year smoothing method. And so whenever we look at the market value as of the beginning of the year, so as of the previous valuation date, the market value was around $52.5 million as shown in item 1. We do look at net cash flow, which is contributions minus benefit payments. And so for 2022, that amount was about $41.8 million. And so whenever we determine what the actual versus expected market value is, we obviously apply the 7.5% assumption to the net cash flow, as well as, you know, the beginning of year market value of assets. And so we did have, you know, with the $41.8 million coming into the fund, and the expected return was about $5.5 million, we should have seen that the market value was around $99.7 million. but the actual market value is around 85.6 million. So for the 2022 calendar year, we did see a total loss of about 14.1 million, which is just the actual minus expected market value. And so as I was saying, the Longview Fire method for smoothing the asset value is over a 3-year period. So the most recent gain or loss, 2/3 of that is deferred, and then for the prior year, only 1/3 of that is deferred. And so if you look in item 7, the 2022 loss of 14.1 million, 2/3 of that, or 9.4 million, is deferred. And then from the 2021 gain of about 2.51 million, only 1/3 of that, or 835,000, is deferred. And so in total, the total deferred gains or losses is a loss of about that 8.6 million. And so the resulting actuarial value is 94.2 million. And so with that total deferred gains as shown in item 7, that 8.6 million, that is the difference between the market value of assets and the actuarial value. And if you look in the prior year, you can see that both of those, or both 2021 gain, as shown in the second line, at that point, 2/3 of that was deferred, and then there was also a 2020 gain as well. And so both of those combined, there was actually a deferred gain of 2.5 million. So in the previous valuation, we actually had the market value being higher than the actuarial value, but this year, with 2022 and a lot of those, or that large loss, most of that being deferred, we do have a significantly higher actuarial value of assets compared to the market value. And then one thing I did want to mention, so our valuation relies on the assumptions that were approved from the experience study that was done in 2019. It is, best practice and recommended that an experience study be performed at least every 5 years. And so with the last one being in 2019, it would be time for another experience study to be performed next year during 2024. And so that would cover a 10-year period of experience from January 2014 through December of this year. And then finally, the last 2 slides are really just for actuarial disclosure purposes. The results obviously rely on the accuracy of the data that we receive for the valuation, and then the summary of assumptions, methods, and plan provisions, as well as the discussion of the risks, is actually provided in the December 31, 2022 valuation report. And then this last slide is really just language that was pulled from the cover letter of the report discussing the use, scope, and the qualifications.
Could you go back to those recommendations? I didn't see them in our handout. I think 3 slides back.
This one?
Yes.
Yes. And so really, in terms of the assumptions, there weren't any assumption changes this year. Normally, what we would see is that the Society of Actuaries, in terms of the mortality assumption, we typically do have a new mortality improvement scale released every single year. But still, the most recently released table is the MP 2021 mortality improvement scale, which is the one that was used in the prior year valuation. The reason, obviously, with unknown impacts due to COVID, the society that produces these tables did not want to produce an MP 2022 table. So until a new improvement scale, mortality improvement scale, is released, we should continue to use the most recently released one, which is the MP 2021.
Do you have any feeling as to when possibly they will make? I know that there's a lot of debate over, do we just pretend COVID didn't happen for that purpose? Do we weigh it in at a certain value? Do we have any idea when possibly an update to that mortality table might come?
I don't believe they've provided any updates, but I mean, in terms of our mortality assumption, I mean, we are still using the MP 2021 scale, but that is, projected 5 years into the future. So we are still reflecting mortality improvements. It's just, not on an updated scale. But we have not heard anything about, whether they want to produce any kind of other scale or produce an MP 2022 or MP 2023 scale yet. So.
Very good. Any questions? I think in line with our past history, we have tried to stick to that 5-year experience study, so we'll have to discuss that as a board, but I feel like we will more than likely move forward with that recommendation.
Okay. Perfect.
All right. Is there more? Am I cutting you off?
No.
Okay, all right.
No, unless y'all have any other questions.
All right. Any other questions? If not, thank you for that. And we will move on to action item C, review and motion, accepting the 2022 actuarial valuation.
Move to approve.
Second.
Got a motion and second to approve the actuarial valuation. Any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. We can actually strike item D as there is no assumption changes recommended. All right. Next, we will move forward with the presentation of the 2022 year-end audit by Henry and Peters.
These are just our bound audit report copies. I'll go over my slides.
Thank you, sir.
Also included in these is a governance letter that I'll go over. So yeah, like we talked about, there's a governance letter that we're required to communicate at the conclusion of every audit. That'll be that top letter that's in your booklet. Basically, going over this, we have to communicate several different items, some of those being significant audit findings. Those are, of course, for a pension fund like yourselves, are the investment values. Obviously, these are significant estimates to the financials as a whole. Market value, as we've seen, continues to fluctuate on a dime, so it's just always something to bring to your attention. Another item to discuss is certain disclosures that we feel warrant extra attention, these being the actuarial assumptions that are in Note 5 of the report. Obviously, these are very important whenever you're trying to diagnose a pension fund's health, and so we want to definitely make sure that the board is aware of those significant disclosures that come from Foster & Foster. I'll defer all questions to them for those. But definitely wanted to bring to your attention. We also use this time to communicate if we have any trouble with management and having to work with any of your staff. Pam's always great to us, even though we probably annoy her, but she is phenomenal in getting us the stuff on time and quickly. And then we also obtain management representations through a letter that we have Pam and the board sign that just basically takes responsibility for certain items and basically allowing us to perform the audit in accordance with GAAP standards. Outside of that, I'll move into the audit report itself. So of course, as you're always worried, is what kind of opinion did we have for the current year? We're happy to say we had a clean opinion. That's noted on page 3 of that report. So what makes it a little bit easier now with these opinion letters is that the opinion's at the top. You're not having to go dive through 4 pages of language that nobody cares to read. So we have the opinion at the top. It's a clean opinion for both 12/31/2022 and 12/31/2021. But this new opinion letter that we give actually gives a little bit more detail between the responsibilities of management along with the responsibilities of the auditor in performing the engagement. So you'll see those in those bottom 2 paragraphs. The next page just kind of gives you a brief overview of audit procedures that we perform, the reasonable assurance that we have to obtain in order to issue an audit opinion. And then this one also has a paragraph in there for other matters, which make up the management discussion and analysis that's on page 5 and 8, and the required supplementary information that's provided from the GASB 67 disclosures from Foster & Foster, and those will be at the back of your report. Moving into the management discussion and analysis summary, This just gives you kind of a brief overview of the financials and footnotes. If you're ever having trouble looking for information, this is kind of another table of contents for you. It gives you a brief overview of each note, what the financial statements are made up of, and what the required supplementary schedules also detail. There's also a brief overview on those in the management discussion and analysis based on assets held by the plan and any kind of contributions and investment income that has occurred during the year. So you'll see that there, but that's also portrayed in the financial statements themselves, starting on page 10. So on page 10, we basically have a statement of fiduciary net position. This is your balance sheet. As a reminder, this is as of 12/31/2022. Obviously, we're 7.5 months into the next year, so luckily the market has significantly changed from that point. But you'll see as of 2021 to 2022, it looks like it was a great, phenomenal year, but we have to keep in mind that there was $45 million in cash contributed into the plan as part of the pension obligation bonds that were issued by the city. So that detailed with, you'll kind of have a comparison between the different types of investments held by the plan. You'll also have some receivables that occur from time to time. Now that's whether payroll ends on a certain date. If payrolls ran and those funds haven't been contributed to the plan, you may have a receivable coming both from the employer and the member side. So that's where you would see those in that top area. The statement of changes in fiduciary net position are also your income statement for easier term. This shows basically all cash that goes into the plan, investment return that occurs, along with any kind of deductions or benefit paid by the fund itself. So as you'll see, that the big 47 million number sticks out at the top, like we talked about with the pension obligation bonds. That's not a huge change there. The rates did go down just a hair from the employer side as a part of the pension obligation funds that we've already talked about. And then, as you'll see, investment loss income, it's kind of a down year. If you remember, the fourth quarter of 2022 was not great for anybody. A lot of our benefit plans and defined benefits like these really had a tough time with the snapshot as of 12/31/2022. The market really fluctuated hard. You've seen some recovery already in 2023. So just as a reminder, these are the significant estimates we talked about, and they do fluctuate from time to time. Overall, with deductions, those stayed pretty well consistent from the prior year. That's just based on termination, retirees, any kind of payments that are paid out based on time served. So those numbers are subject to stay pretty well the same, except for maybe some significant drop payments that will occur from year to year based on individual members that retire. But as you'll see, your net pension increased to about $85 million. And as a reminder, that's fair market value. It's a little bit different, but we kind of show that number alongside some of the actuarial information that may differ. And then just some of the high pieces of the notes to the financial statements. We did have a new lease standard that goes into place. I'm not going to bore you with all of it. Basically, it requires every financial entity to record leases on their balance sheet and show obligations that are due. Y'all rent office space. It's very immaterial. There's no adjustment for that, but we do want to bring it to your attention just as part of it. Note 3 that's on page 15 will detail out contributions. There is a snippet in there regarding the general obligation pension bonds that were issued, along with the changes in employer percentage as a part of those. No big changes there. Note 4 is a very, very big investment footnote. So if you'll remember from the Pension Review Board, they require some excess disclosures now, and those starting on page 15, and I believe going for several pages. Page 18, I believe, is the big one. Yeah, so page 18 is the big one that Pension Review Board would like to see. So it's basically we have to detail out what fees are paid directly from the plan, what fees are paid net of investment returns. And so we make a reclassification journal entry between dividend income or investment income and investment expense to show any type of fees that were paid as part of investments without cash actually being paid out of the plan. And so that's PRB wants everybody kind of on the same universal footwork, so that you can kind of compare apples to apples when they're looking at the 80 to 100 some odd entities that are required to submit audit reports. And so outside of that, the last biggest footnote is note 5, and it's the actuarial assumptions like we talked about. I'm not going to go into too much more detail, but the big piece that we look at whenever we're comparing the different benefit plans for for fire pensions is the unfunded actuarial liability. And so that's a big piece in kind of decoding as far as how healthy the plan is itself. It's good to see the funds paid into the plan and see that unfunded actuarial liability fall down quite a bit. So that's really the last piece of the audit report. There's some more footnotes at the back that are pretty standard and recurring from year to year, so I won't go into too much further detail. And then at the back of the report are the required supplementary schedules that come from that GASB 67 report from Foster and Foster.
On page 12, do you not have the 2022 membership numbers?
Let me find page 12. Can you ask that again? Sorry.
On page 12, do you not have the 2022 membership numbers?
Oh, it looks like that table is not updated, so that should be 2022 and 2021. So I'm not quite sure why that did not get updated, but we can get that changed.
On page 17, is that a 21 number or 22?
17.
Under note 4?
That is a 2021. The 2022 is on the page before, on
Okay.
page 16. Yeah, it just broke out that way. So yeah, it looks like just the heading of that one table in note 3 did not get updated, but the figures themselves are updated.
How about page 19? Is that 21 numbers at the top or 22?
'19, that's 2021. 2022 is on the page before that as well.
Okay,
On
good.
page 18.
Any other questions? If not, under action item E, we have a review and motion accepting the 2022 financial audit with noted changes.
Move to approve.
Second.
I have a motion and second to approve item E. Any discussion? If not, all in favor say aye. Aye. Anyone opposed? Motion carries. Thank you, Tyler.
Yeah, thank you.
And thank you, Lindsay. I don't think I thanked you for your presentation. All right, moving forward, action item F, review and motion regarding the reconciliation for the month of July 2023 for the Moody checking account, Moody disbursement, and Morgan Stanley Smith Barney omnibus, which should be found under your financials and reconciliations tab.
I move to approve.
We have a motion and second to approve action item F, the reconciliation for the month of July, Moody checking, Moody disbursement, and Morgan Stanley Smith Barney omnibus. Is there any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Item G, review and motion regarding the internal financial statements for July 2023, which will be under the financials tab. ending July at 93, just over 93 million.
Yes. Which last month was just under 91. I move to approve the balance sheet for financials for July.
I have a motion and second to approve the internal financial reports for July 2023. Any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Item H, review and motion regarding the minutes for the July 2023 meeting.
I move to approve the minutes for last month.
All right, motion and second was made to approve the minutes for the July 2023 meeting. Any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Item H, review and motion regarding the retirement and drop for retiree Brian Jones, as displayed to my right. I actually reviewed this retirement, so I will make the motion to approve this because I did check it.
Second.
Had a motion and a second for action item I, the retirement and drop for Brian Jones. Any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? No. One abstain?
One abstain.
Motion carries. Item J, review and motion for the refund contributions for Gary Orr due to separation. I also reviewed this, and I will make the motion to approve.
I'll second it.
Got a motion and a second for item I, review the refund contributions for Gary Orr. All in favor say aye.
Aye.
Anyone opposed? Motion carries. Well, I wish I would have turned this over first. We'll go ahead and review K and L at the same time. The refund of contributions for Andrew Gillis and rollover of contributions for Chase Rouse, both due to separation. I also reviewed these and will make the motion to approve both items K and L.
I'll second.
We have a motion and a second for items K and L of refunds or rollover of contributions. Is there any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Item M, review and motion regarding the qualification of a quadro for a pension member. I believe that is in the cover of your book. I have reviewed this. It is our standard format of quadro, and it does meet our standards that we have set forth as a plan for any lump sum distribution. And based off that, I will make the recommendation again to approve the quadro for the pension member.
Second.
All right, we have a motion and a second to approve the quadro for a pension member. Is there any discussion? If not, all in favor say aye.
Aye.
Anyone opposed?
One
Motion-
abstain.
One abstain. Motion carries. Thank you for catching that. All right, discussion items. Discussion of upcoming retirements. I believe I know of one.
Matt Bryan's leaving in November, is what he told me.
Make that two. So, I think David Holly, did he put in his intent, which he would be a vest terminate, so no payment will come until his 50th birthday or whenever he decides to apply. I believe those are the only two that I'm currently aware of. All
Are they
right.
required to file anything with y'all as a notice or no?
We ask, not as the pension board, I think the fire department asks that they file, if it's a planned event, typically they like for them to file pre-budget time so they can try to budget in any type of, I guess, refund of sick and vacation payout, but there is no requirement to file with us until they actually plan on doing that. I think under city policy, if you don't give a 2-week notice, it can affect your recommendation for any future employment from the city. So it's pretty standard to give a 2-week notice to comply with that city policy. But as a pension fund, no, sir.
The only thing is we require them to let us know what they're doing with the money within 90 days. Or,
And that's like a quadro, or they're gonna annuitize it or whatever.
right,
Okay.
yeah.
All right. At this time, because of the retirement of Assistant Chief Jones, he is serving, you're in your first year? Second year. Second year of your term?
Yeah.
All right.
It's 1 year left.
All right. We do need to open up a nomination timeframe to elect a firefighter board member to fill the unfinished term of Brian Jones. We typically put it out for 2 to 3 weeks. The members are required to nominate someone, and on that nomination, they need to get 10 signatures, basically stating people that would be willing to vote for them. Has really cut down on Mickey Mouse running for the pension board and the fire department on occasion in the past. So we need to, I guess, set dates for opening up that position and when that will close so that we can tally them at the September meeting. Our September meeting on the 19th, so we could close it on the 15th. September 15th, and I would recommend close it at noon, and that would allow Pam an hour to at least compile any nominations there for the upcoming meeting the following Tuesday. So if we back that up, well, really no reason to not open it just as soon as we can get the papers filled out and just leave it open for that time frame.
Is there any qualifications you look for people that are interested, a certain rank or
They have to be a fireman.
experience?
Yeah, by statute, they have to be an active plan member.
Yeah.
Other than that, we try to at least explain to anyone that is interested in the position of the commitments we'd like to see them make in the way of active participation on board meetings, active participation of training, required PRB minimums in the way of CE that they'll be required to get in their first year, and move forward from there. Obviously, someone that has some financial understanding or the willingness to learn that is one of our biggest, I guess, decision-making factors, but it's the members that actually nominate people. So we, other than us explaining to them what the requirements are, we really don't have an influence other than our individual votes as a member of the fund as to who obtains that position.
Thanks.
And then say there's 2 or 3 of them, and then do we vote on it? No,
Nope.
they vote on it.
They
Yeah,
have to get
vote
the
on it. That's
majority
right.
vote.
Oh, so they do vote, okay.
Yeah,
Yeah.
they do the voting, and based off that, if we don't have someone who acquires at least 50% plus 1 vote, we will have a runoff if that's required.
We used to have a vote even with 1 nomination, but now if there's only 1 nomination, we can vote that as a board that as the member.
All right. Item C, upcoming conferences. The TELFRA Annual Conference will be held October 1st through 3rd in Corpus Christi. If anyone is interested in going that has not registered, if you'll get with Pam on that. That is a very specific conference in regards to, it's very targeted towards TELFRA funds and not just towards general employee retirement system. So you will receive CE credit for attending that, and we need to get you registered ASAP, because I know the hotel rooms are about, the book portion of them are about sold out, but we are working on increasing that allotment.
Are we gonna, so will we have the new member in before then? Do we need to get a room and just put it under our name for that person for now, for about sold out?
We're gonna do the nominations and the election if necessary prior to the September meeting.
No.
No, so at the September meeting, they would be, yeah, it would be worthy of obtaining a room if
Yeah.
they were able to attend and make it.
Because they'll be elected before the conference, but might be not attend a meeting and be sworn in yet, so it'll be good to go. Because if we do the election or do the nominations on the September meeting, we'll have to do the election between then and the October meeting. Just do all that. If it's just one nomination, then they could be sworn in on the September meeting.
That's true.
Yeah, pending the number of
That's
of
true.
applicants to it, yeah. All right, any other discussion? Our next regular scheduled board meeting will be back at the pension office on September 19th at 8:30 a.m. If not, do I have a motion to adjourn? Is there any other discussion? If not, do I have a motion to adjourn?
Motion.
Second? All in favor, say aye.
Aye.
Thank you for attending the meeting. This meeting is now closed.